From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, a payroll surprise teeing up the Fed, sending bond yields to multi-year highs as the BOE hikes and the ECB begins to shift. We begin with a big issue, a bright green light to make a move.
This jobs report this morning, this blockbuster gain.
It's pretty impressive.
You don't see the expected Omicron impact.
We got a positive surprise.
You're starting to see people, which I think is durable, will come into the labor force.
It's one of the most difficult environments for the Fed to face.
The Fed has already checked the maximum employment box.
Some of the moves that we've seen from central bankers globally.
It is a big deal. With regard to the Fed, the Bank of England and the ECB just made their job a bit easier.
The Fed is further and further behind, and they're going to have to catch up.
This report does a lot to continue to accelerate that theme of upfronting the pace of Fed hikes.
And we're talking about 5 and 6 and 7 hikes.
As the Fed and global central banks pull back,
that's going to cause some challenges,
particularly as it relates to the bond market.
Joining us now to discuss Lafayette's Krishna Memani, Morgan Stanley's Michael Kushma, and Kathy Jones of Charles Schwab. Now, Kathy, we've got to start with the payrolls number. I think we all spent the whole week preparing to tell everyone why this number does not matter, and then all of a sudden for this market, somehow it matters in a big way. Kathy, your takeaway first, please.
Well, I think a couple of things. One is that clearly Omicron did not have the impact that we thought it would have. So that's actually a good sign. It means that as Omicron wanes, we're going to continue to probably see some further improvements. There are lots of quirks in the numbers, seasonal adjustment factors, and you know, the baseline changes. But overall, you know, still a strong and improving job market, and that keeps the Fed on track to tighten.
Krishna, we were told not to pay attention to it. Why should we now?
Well, so I think before today, if the numbers were weak, we could have brushed it off. But expecting numbers to be weak, given the current environment, they came out as strong as they did. And I think we have to pay a great deal of attention to what's really going on. The Fed is certainly behind the curve, but that's besides the point. I think even the Fed knows that. The real question is how quickly are they going to tighten both from a quantitative tightening standpoint and policy rates. To me, anyway, it seems that they are still very reluctant, and we will see over the next few months as to if they're changing their tune on that front.
Anil Datta of Renaissance Macro is changing his tune a little bit. This is what he had to say. Revisions surged 709,000 over the last 2 months. January beat while expectations were heading south into the report. The Fed increasingly offside relative to the data flow. You cannot rule out a 50 basis point move at the March meeting. Michael Kushma, your thoughts on 50 basis points next month?
I think it's still off the table. It's obviously possible, but I think this number was strong, but it was not as strong as it looked. There was a lot of, as mentioned, seasonal adjustment issues. If you subtracted out a lot of the BLS adjustments they've been doing over the past year, that increased a lot of payroll and employment growth the last couple of months, but subtracted from earlier in 2021. So the report is strong, but I think just as we would dismiss too weak a number, we should not dismiss, but not think that this changes the game plan of the Fed too dramatically relative to what was before. So I think we're still on track for sequential hikes earlier in the year, but to move up fairly quickly to, the 1% level, 4 hikes pretty quickly, and then see, how it goes.
Big move in the bond market off the back of it. Either way, up 12 basis points on 2s to 132. Bank of America say this, and they're in the 7 hike camp for 22. Let's be clear about that. We think today's report keeps the Fed on track to hike rates by 25 basis points at every meeting this year. The strength of wages could lead to more persistent inflationary pressures that the Fed will want to start counteracting. The market's picking up on some of this, Kathy. It's not the base case yet, but that's the centre of gravity. It's leaning in that direction. 5, maybe more. You're not there, Kathy. Why?
The reason I'm not there is I really would like to know what the plan is for quantitative tightening. So if there's a lot of optionality that the Fed has with the balance sheet, and we don't have that plan yet. We have general principles, but I can see them hiking quickly over the next couple of meetings. But then as quantitative tightening starts to have an impact, that could take the place of a number of rate hikes. You know, it remains to be seen, but I think calling for 7 is premature at this stage of the game. We really need to see what the QT plan is and how things evolve over time. The other thing I'd say is just because wages are rising doesn't necessarily mean it has to be inflationary. So my take is that what we're seeing is, you know, some of the income go to labor that has been going to capital. Not necessarily a bad thing for the economy, keeps the economy strong, but not necessarily inflationary.
Krishna, what I hear from you is that you don't think this Federal Reserve has actually capitulated just yet. I'm trying to work out what's being priced now into the bond market, into rates, and why you don't think this central bank has capitulated yet.
I don't think the central bank has capitulated yet. And I think if you, the best sign of that really came from Bank of England far more than what the Fed has been saying. You know, they're still talking about kind of orderly rate rise and things like that. So whether that's the right policy approach or not, I'm not debating. But I certainly would say that the Fed or the central bankers in general haven't capitulated. I think I need to counter a couple of points that were made earlier.
Sure.
One, yes, the payroll number this month alone shouldn't lead us to too many broad conclusions. But if you go back and look at the revisions, I think that ought to scare the living daylights out of the Fed. So I think there's a lot in this payroll report to kind of have them look a little deeper than what they perhaps have done so far. And secondly, when wages are rising at 9% rate, I think that's a problem. That's inflationary. It doesn't, you know, if it was 2 or 3 or 4 or 5%, you could justify that. There's no way in productivity terms you can justify 9% wage increase and not worry about it.
Krishna, just build on what you said previously, and we can get into the wage discussion. I want to bring Kathy back in on that. This is not a therapy session for central bankers, so let's be clear about that up front. But reading the room just a little bit over at the Bank of England, they seem spooked. Krishna, to have Governor Bailey tell people they shouldn't ask for a big pay rise. President Lagarde was crumbling in that news conference. She'd been gripping tight to the T word. I didn't even hear it come out of her mouth for the whole news conference. There is a real worry there, Krishna. Are you not picking up on that you can sense a little bit of nervousness now from these central bankers?
I think they're extraordinarily nervous. There's no doubt about that. But the question is, how does that nervousness turn into policy? And I think on that front, they're still on the cautious front, thinking that it may eventually turn out to be transitory. And I think that is really the biggest challenge for this economy. For now, we don't really have too much of a scare. We have enough momentum. We have an inflationary boom going on. So the likelihood of recession is pretty small. But if they continue down this path, and nothing changes, the labor participation rate, which didn't change really after population control adjustments, if that doesn't change by the second half of this year, we are talking about bringing down the hammer. And that raises the possibility of a recession. And I think the policymakers are scared because that's the conclusion they absolutely, positively do not want.
That's the worry, and that's where Bank of America are. They say it's inflation shock, followed by rate shock, followed by growth shock. Kathy, I promise to bring you back in.
Yeah, I mean, I think that certainly wages are rising and that can fuel inflation. But I also think that we have to recognize that wages haven't kept up with productivity for a long time. And so some of this is catch up. And I'm not sure that it's going to turn into a wage price inflation spiral that everyone's worried about, or a lot of people are worried about. But clearly we've got a lot of inflation. We still have supply side issues. Demand continues to be strong. And, you know, the Fed's only tool is to slow aggregate demand, and that's what they're going to use. Does it risk a recession? Sure. If they have to move very quickly, we'll see that in the inverted yield curve, and we'll start to see expectations that we're going to have a hard landing. Again, a little bit premature to say that, but that certainly is a risk that's on the horizon. That's why we've seen so much curve flattening so far.
Michael Kushma, let's talk about the yield curve. Yes, it is flattening again by several basis points. A big move at the front end by 12, but a 10 years up too by 9 basis points. The belly of the curve is elevated as well, almost in line with what the very front end of the yield curve is doing. What's your read on that at the moment, Michael?
Well, I think what's happening is that the market is flirting with the idea that its idea of a terminal rate below 2% may be wrong, given the momentum which exists in inflation, wages, employment growth in the United States. And that right now, the Fed's been talking about 2.5% terminal rates, maybe even higher temporarily to get inflation down. But the market's been unwilling to buy into that. So what's happening, I think, is that the market's starting to reassess the probability that rates will not stop at 175. We're going to 2, 2.25, 2.5. And the belly of the curve, call it 3 to 7 years, is very vulnerable to that idea over the course of 23, 24, that short rates are going to go much higher than anticipated right now.
And for sure, threes aren't there right now. We've got a lift today, but we're at 155. Fives are at 178. I'm just looking at the dot plot for 2023, and they're just north of 2%. The long dot, 2024 and out to the longer term, we don't even really get near 250. That longer term dot, Krishna, that's where it's sitting at 250. But talk to me about the belly of the curve, 2023 dot, how much work we'd need to see in the dot plot at the next meeting, never mind the rate hikes. Let's talk about where this is going further down the road.
Well, so the dot plots are certainly going up, but I would make another point, I think, that is far more relevant. I think if you're worried about growth in 2023, looking to the bond market to come up with those types of conclusions, I think is a fool's errand in my judgment, because the bond markets are getting impacted by lots of other things other than just U.S. employment and inflation and things like that, which is there are global factors at work that certainly have an impact on it. So I think if you're looking for the status of where policy is going, don't look at the bond market. Look at what's going on in the employment data, and that there's plenty to worry about on that front.
We're going to talk more about this market in just a moment. Just to clarify, the 2023 median dot, just above 150. There is a group of dots above 2. And on the 2024 dot, the median dot just above 2. You just wonder how much work we're going to do there in the coming month at the Federal Reserve. Bill Dudley, the former New York Fed president, called this fantasy land, these forecasts from the Federal Reserve. We'll talk about that a little bit more in a moment. Krishna Memani, Michael Kushma, Kathy Jones sticking with us. Coming up next, the auction blog, the world's largest theatre operator doubling its offering amid strong demand. That conversation up next. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction blog, where we kick things off over in Europe with a host of rate decisions leading to another zero deal Friday. Early offerings from IBM and Italy still boosting sales to the highest level in 2 weeks. In the US, high-grade bond sales gaining some momentum. Bank of America's $9 billion deal helping sales surpass weekly estimates. And finally, AMC Entertainment coming to market for the first time in nearly 2 years, boosting weekly sales to more than $5 billion. As we wrap up the week, something fascinating happened this week that we haven't seen in a long, long time. The last time the ECB hiked interest rates was July 2011. Since then, they have come nowhere close. In fact, this was the first time in more than a decade that the ECB seemed to be even thinking about raising interest rates. Take a listen to what the ECB president had to say on inflation.
There was unanimous concern around the table of the Governing Council about inflation numbers. We are all driven by the same mandate, which is price stability. And we are all concerned to take the right steps at the right time.
Back with us, Krishna Memani, Michael Kushma, Kathy Jones. Kathy, we've had the pivot from the Federal Reserve, the pivot from the Bank of England. Was that the pivot from this ECB?
It certainly sounds like it. I think that, you've had negative rates there, nominal rates there for so long, and it is looking like they're going to have to make a change. And look, we've seen rate hikes all over the world for the last year. EM, particularly in Latin America, and now the U.S. And Bank of England. I think it's going to be hard for the ECB to sit there with the depot rate so low when the rest of the world is seeing these rate hikes.
Michael Kushma, this adjustment on the front end of the Italian curve, never mind Germany, which is getting all the headlines, there's some fragility here. The Italian 2-year, yesterday up 20 basis points, up another 15 basis points today. My colleague Lisa Abramowitz called this Europe's taper tantrum. Is that what you see emerging here, Michael?
Well, it's going to be a challenge. One of the issues that Europe has faced was back in 2011, 2012, they were in the midst of a sovereign debt crisis. And Italy was sort of in one of the leaders of that issue. And a lot of policy since then, in terms of the quantitative programs, the central bank buying of peripheral debt in Europe, has been to support those economies, make sure the flow of credit and resources go to those countries when cross-border private sector capital flows had really dried up. So this is a point of concern for the ECB to make sure that Europe as a whole does well, not just parts of Europe, and certain parts don't fall behind. On the other hand, they have much better, bigger programs in place now to deal directly with sovereign debt issues. They don't have to just use low interest rates to sort this out. So they will face a challenge in making sure that parts of Europe doesn't get ahead of each other in terms of rates go up too fast in the periphery because of worries of lack of policy support for those regions during this transition phase to stronger growth, higher inflation, and maybe to zero rates in the next 12 to 18 months.
We hope the stronger growth is what comes with it, and I think that's the fear that maybe it won't. Looking at the print we had from Germany for the last quarter, Krishna, for Germany, we're just pulling the whole of the yield curve out of negative territory. Point by point, the 5-year turning positive. We're looking at a 2-year inching back towards zero. Krishna, for as long as I've known you, we've talked about, in some ways, the German debt market just being an anchor for the global bond market. If that changes, how does that bleed out into the rest of the world?
Well, so I think Italy is basically showing you that. That is, for German bond markets, you have private sector buyers. But in Italy, basically, all the issuance is bought by the central bank in one form or the other. And therefore, the moment that anchor goes away, the prices have a tantrum as they're supposed to have. So I think if the German anchor goes away, much the way I think that will have longer term global implications far bigger than what we are contemplating today.
Do you think we're already seeing some of that at the moment? And Krishna, I want you to build on this, just beyond the bond market. I'm seeing single name stocks making 20% moves, 100 billion here, 100 billion there on a single name. I'm seeing this stuff emerge in Italy. Is there anything taking place in credit right now that is a real cause for concern, do you think, Krishna?
Well, so I think the likelihood of a substantial temper tantrum on a global basis is increasing and increasing very rapidly. And I think you're seeing that in the equity markets because they were overvalued, or some parts of the equity markets were overvalued. But I don't think you have seen to the same level in credit markets, for example. So I think the likelihood of a global temper tantrum is increasing. And the real test would come when the actual quantitative tightening starts both on this side of the Atlantic and even Europe at some point.
And Kathy, this is it. We haven't seen a rate hike from the ECB yet. It's been priced in for the back end of this year. A lot of banks coming out with that call. Deutsche Bank, one of them. They closed their euro dollar short and bang, just like that, they go long the euro, looking for rate hikes later and an acceleration of that taper. Kathy, we haven't had the hikes from the Federal Reserve either. And this is the conversation we're having before any of this even happens. Kathy, we've seen taper tantrums before. 2013, of course, that was the year that really coined that phrase. We've worked through it again. Can these central banks deliver what people are talking about without causing a massive problem in this market, which leads them just to back away again?
Well, it's a real concern of ours. I mean, we came into this year talking about this being the year that the easy money goes away and that tide ebbs. And the fact that it's moving so much faster than it was anticipated raises a lot of risks of liquidity problems in the market. So today we saw high yield get hit pretty hard, even though the duration on high yield's not that high in the U.S. relative to, say, investment grade. And this suggests to me that we are starting to see people flee some of the higher risk parts of the market and try to move out of the less liquid parts of the market. So I think if there's a concern that I have is that if this moves really fast, yeah, we could have a liquidity problem. Financial conditions could tighten very, very quickly. And the central banks would become stuck with, how to maneuver through the tightening financial conditions and the inflation pressures that they're trying to quell.
The cross currents right now are amazing, and the backdrop is crude keeps climbing. 92.64, WTI, Brent at 93.41. These central banks have got a big issue this year, that's for sure. Krishna Memani, Michael Kushma, Kathy Jones sticking with us. Still ahead, the final spread, the week ahead, featuring another big CPI print in America. We'll get our teeth into that briefly in just a moment. From New York, this is Bloomberg. From New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up, China PMIs coming on Monday, followed by trade balance numbers on Tuesday. We get an RBI rate decision on Wednesday, plus Fed speak from Cleveland Fed President Loretta Mester. A ton of Fed speak, I imagine, through the week. That 50 basis point question could get very, very interesting given the numbers we've had today and going into the big one on Thursday with CPI and initial jobless claims. Just briefly on CPI, your estimate, the median right now, 7.3%. The previous read was 7%. And I'm just looking at a range of estimates that have already come through on the Bloomberg. We've got about 25 estimates so far. 7.3 is the median, 7.6 is the high, the low is 7, just to give you a sneak peek and a feel of next week. Let's get to the rapid fire round with Krishna, Memani, Michael Kushma, Kathy Jones, and let's start right there. Give me a number for next week on CPI. Just give me a number, Kathy.
I'll give you 7.
Krishna.
8.
8. Michael.
7.4.
March, 50 basis points or 25 from this Fed. 50 or 25. Krishna.
It's 25, but I hope it is, but I think it may change over time.
I think someone was calling to tell you 50. Michael, 55, 50
25.
or 25? 25.
25.
Kathy?
25.
Final one from me. I've asked this question over the last several weeks, and I think Kelsey Barrow of JP Morgan Asset Management was the only individual to say yes, they would. Everybody else just said no, no, no. And I imagine now the answer to this question has changed. Does the ECB hike before year end? Yes or no? Kathy?
Yes.
Michael?
Yes.
Krishna?
Yes.
Unanimous. I expected that. Guys, thank you so much for being with us this morning and through the afternoon on Bloomberg TV and on Bloomberg Radio. From me, that does it for me until Monday. Krishna Memani, Kathy Jones and Michael Kushma. From New York City for our audience worldwide, this was Bloomberg Real Yield. This is Bloomberg TV.